Welcome to our lecture series on financial derivatives. Today, we will talk about using financial options to speculate, hedge, and generate income. Let's begin. Options are versatile financial derivatives, offering investors powerful tools to manage risk and pursue various financial objectives. This lecture will explore the three main uses of options: speculation, hedging, and income generation, providing a comprehensive overview for college students. First, let's delve into using options for speculation, which involves taking a position to profit from expected movements in an underlying asset's price. Consider an investor who expects Tesla stock to rise from $250 to $280 within the next month. By buying a call option with a strike price of $260, the investor gains leveraged exposure, meaning a small investment can control a larger asset value. If Tesla stock indeed rises to $280, the option payoff would be $20 per share, less the premium paid, resulting in significant profit. Conversely, an investor might believe crude oil prices will fall due to excess supply. Buying a put option on crude oil futures gives the right to sell at a predetermined strike price. If crude prices fall below that strike, the put option gains significant value, allowing the investor to profit from the downturn. Next, we explore hedging, which involves using options to reduce risk exposure from an existing investment. A common hedging strategy is the protective put, designed to limit downside risk on shares already owned. Imagine an investor owns 1,000 shares of Microsoft at $300 each. To protect against a potential decline, the investor buys put options with a strike price of $280. If the stock falls below $280, the put option increases in value, offsetting losses from the stock and effectively limiting the downside. Another hedging strategy is the covered call, where an investor sells call options on shares they already own. For example, an investor holding a portfolio of S&P 500 ETF can sell call options at a higher strike price. The premium collected from selling these calls provides partial downside protection, though it caps the potential upside if the ETF rises significantly. Finally, let's explore using options to generate income, a strategy focused on collecting premiums. Covered call writing is a popular income generation strategy, especially for investors holding a stock long term. Consider an investor who owns 500 shares of Coca-Cola at $60 each. The investor can write call options with a strike price of $65, expiring in 1 month, collecting premiums up front. These collected premiums provide additional income, enhancing the return on their existing stock position. If the stock rises above $65, the shares may be called away, but the investor still profits from both the capital gain and the collected premium. Another income strategy is cash-secured put writing, where an investor commits cash to buy shares at a specific price if the stock falls. For instance, an investor willing to buy Apple shares if they drop to $150 from their current $160 can sell put options with a $150 strike. If Apple stays above $150, the premium collected is pure income, as the put option expires worthless. However, if Apple falls below $150, the investor buys the shares at an effective discount, which is the strike price minus the premium received. In summary, options are powerful tools for diverse financial goals. Speculation allows for directional bets on price movements, offering leveraged profit potential. Hedging through strategies like protective puts or covered calls helps reduce downside risk on existing investments. And income generation, using covered calls or cash-secured puts, provides a way to collect premiums and enhance returns. Understanding these strategies is crucial for any investor looking to effectively utilize financial derivatives. Thank you for watching our lecture on financial derivatives, focusing on options to speculate, hedge, and generate income. See you at the next lecture.